The Bursar's ledger for Merton College, Oxford, has an entry dated sometime in the autumn of 1348. It is written in careful Latin. The rents collected from their farmlands in Berkshire and Oxfordshire are listed. The tenants' names are there. Some are crossed out, not because they moved, because they died. The Black Death had reached Oxford. By most estimates, the city lost somewhere between a third and half its population that year. And yet, the entry continues. The next quarter's accounts follow. The rents, reduced, yes, because fewer tenants remained, because some fields sat empty, but continuing. The college survived. It is still there today, founded in 1264, still endowed, still operating, still accumulating. That detail is easy to skip past. It shouldn't be. So because the question isn't how Oxford's colleges survived the Black Death. The question is what structural decision, made by the people who set these institutions up, made it possible for them to outlast everything else around them. Kingdoms changed. Currencies collapsed. Religious regimes rose and fell so violently that people were burned for holding the wrong belief about transubstantiation. Entire industries that defined English economic life in 1300, wool, weaving, certain agricultural structures, were unrecognizable by 1600. And through all of it, these endowments continued, not just survived, grew, and the mechanism they used is the same one most people trying to grow their own savings consistently get wrong. This script is going to trace that mechanism through 500 years, wire through wars and crises and regulatory shocks and market collapses, and it will land on something specific, not a philosophy, a ratio, a number that you can apply tonight to whatever you hold. There will be 3 moments where the answer looks obvious before it turns out to be wrong. The first has to do with land. In the medieval period, when scholars at Oxford and Cambridge colleges first designed what we might recognize as an endowment structure, they faced a theological problem. The church forbade lending money for interest. Usury. You could not, as a Christian institution, invest capital and collect returns on it. And so they did the only thing available. They invested in land. They held farms, collected rents, and used those rents to fund scholars, maintain buildings, and, critically, reinvest in more land. Where in medieval times, the only way for a college to generate a regular income was to own land. Investing money to yield a profit was forbidden by the church. The more land a college owned, the greater its income, and the more fellows it could subsidize. Property Chronicle. This sounds like a constraint. It was actually an accident of extraordinary design. Land does not disappear during a currency debasement. Land does not become worthless when a king decides to devalue the silver content of coins, which English kings did repeatedly. Land generates income in the currency of whatever regime currently exists. When Henry VIII dissolved the monasteries in the 1530s and redistributed their holdings, the Oxford colleges that had secured their land titles properly navigated the disruption. Those that had not faced something more precarious. Here is what the Wars of the Roses reveal about this structure that the peaceful periods hide. The accounts for University College, Oxford for the financial year starting in June 1460 show that its real income fell by half that year, before returning to normal in the following year. The most brutal fighting in the Wars of the Roses had occurred that financial year. The fellows decided it would be unwise to visit their more distant properties in Yorkshire, and sat that year out in Oxford. Property Chronicle income halved. The institution continued. The following year, it recovered. What made that possible was the rule already embedded in how the endowment was structured. Spend less than you earn in good years so that you can survive without selling assets in bad ones. Not a strategy written down anywhere. A structural fact, or an architecture. And that is the first partial answer to the question this script opened with. These institutions survived because they were designed around a gap. the gap between what they earned and what they spent. Every year that gap existed, the corpus, the principle, remained intact. Every year it remained intact. It generated more income the following year. Over decades, that gap is a modest surplus. Over centuries, it is the difference between an institution that endures and one that doesn't. But here is where the obvious answer starts to become the wrong one. If the mechanism is just spend less than you earn, then the logical conclusion is spend as little as possible. Maximize the gap. Starve the institution of current expenditure, grow the principle, repeat. Some medieval colleges appear to have done exactly this, nigh hoarding rather than deploying, and most of them are no longer notable examples. The ones that survived and thrived were doing something more nuanced. They were spending enough to maintain the function that justified the endowment in the first place. Funding scholars, maintaining reputation, attracting new gifts, while preserving enough of the principle that compounding could do its work across decades. This distinction matters enormously, and it will matter more before this script is finished. Harvard understood this instinctively, even in the early colonial period. John Harvard in 1638 bequeathed his library and half of his estate to the newly founded Harvard College. Heist Phil, that original gift, was tiny, a few £100 sterling, a collection of books, but the institutional design around it replicated something the Oxford and Cambridge colleges had encoded across centuries. The principle was permanent, the income was deployable, and the institution's identity was built around the idea that the endowment would outlast any individual generation of administrators or donors. Harvard's lead in financial capital was established, as one historian observed, not by banking a few enormous gifts, but by pursuing a compounding strategy that no single gift can achieve. The outcome was determined not simply by spending gifts from major donors hist Phil, but by what happened to the principle in the decades between them. By the mid-20th century, the standard institutional endowment in America had drifted into something that looked cautious, but wasn't. Why, the typical university fund sat in a 60% stock, 40% bond allocation. Liquid, conventional, designed to protect against short-term loss, and it was quietly destroying purchasing power because it was optimized for the wrong thing. It was optimized to not look bad in a given year, rather than to compound effectively across a generation. The spending rate was often set by committee, politically, at whatever felt generous enough to fund current operations without triggering donor anxiety. There was no rigorous arithmetic behind it. And so the gap between what was earned and what was spent, the gap the medieval colleges had stumbled into by necessity, was being closed from the wrong direction. This is the surface problem. The surface problem is, how do you invest an endowment? And the deeper problem, the one that took another 30 years for the institutional world to name clearly, is, how do you set a spending rate that preserves the principle across a multi-generational time horizon? Those are different questions, and until someone asked the second one clearly, the answer to the first one was always incomplete. In 1985, a 31-year-old named David Swensen took over the Yale endowment. It was worth $1.3 billion. When Swensen started managing the Yale endowment in 1985, it was worth $1.3 billion. By 2021, this had grown to $31.2 billion after disbursements. Average annual returns over the 30 years to 2020 were 12.4%. That's Wikipedia. That number, after disbursements, is doing enormous work in that sentence, and almost nobody stops on it. The endowment was not just growing. It was growing after giving away a substantial fraction of its value every single year to fund the university. The compounding was happening simultaneously with the spending, and the spending rate was the thing Swensen and his colleagues thought about with the most precision. In justifying its 5.25% target contribution, Yale's investments office noted that its spending policy is reviewed regularly and adjusted to take into account portfolio characteristics and market experience. The last 10 years, which do not represent a full market cycle, saw an extraordinary bull market run, but long-term market returns after inflation have been more muted. As such, we believe that our spending rule remains appropriate given the university's multi-generational time horizon. Yale Daily News. Notice what that statement is actually saying. The spending rule is set relative to long-term real returns across full market cycles, not relative to current performance. It is not set by what the endowment needs to give the university today. It is set by what the endowment can give indefinitely, without diminishing the principal in inflation-adjusted terms. That is a precise and uncomfortable standard. It means that in good years, you don't spend the surplus. You reinvest it because you know a bad year is coming and the principal must remain intact to survive it. Here is where the structural reversal arrives. By 2008, the Yale model had become the most admired investment framework in institutional finance. Swensen had pioneered the move into alternative assets, private equity, real assets, timber, hedge funds, venture capital, before most endowments had even considered the category. Particularly revolutionary at the time was his recognition that liquidity is a bad thing to be avoided, rather than a good thing to be sought out, since it comes at a heavy price in the shape of lower returns. Wikipedia. The logic was coherent. An institution with a perpetual horizon doesn't need liquidity. It can tolerate being locked into an investment for years. The premium for that illiquidity shows up as higher returns. Dozens of endowments tried to copy the model. They shifted into alternatives. They reduced liquid holdings. They chased the same returns. And then, right in the autumn of 2008, something happened that the model had assumed away. Everything became illiquid at the same time. The private equity funds that were supposed to be the engine of superior returns issued capital calls, demands for additional cash, precisely when the endowments had the least cash to supply. The alternative investments, which had been valued smoothly and optimistically on the way up, stopped generating the liquidity that the spending rule assumed would come. The Harvard University endowment, which held $37 billion in June 2008, was reduced to $26 billion by mid-2009. Wikipedia Harvard, of all institutions. The institution with the longest continuous investment record in American history, not because the strategy was wrong in principle. It is because the spending rule had been running at a rate that assumed the liquidity premium would always be available, and in 28 and 29, it wasn't. This is not what most accounts of 2008 focus on. Most accounts focus on the returns. The right question is, what happened to the spending rate when the returns went negative? The institutions that survived in the best condition were the ones that had built the most conservative spending rules relative to their asset base. Not because they earned more, because they had a larger buffer between their principal and their obligations. The medieval colleges, sitting out the Wars of the Roses in Oxford, waiting for their Yorkshire properties to become safe to visit again. The structure was the same, 7 centuries apart. And if this pattern is worth following, and the historical record is consistent enough to be worth taking seriously, subscribe and hit like. The next piece looks at what happened to the endowments that copied Yale's asset allocation, but not its spending discipline, and the outcomes were not equivalent. This one changes how that one reads. What the endowments rebuilt on after 2008 was instructive. By 2019, when absolute return, private equity, and real assets accounted for approximately 77% of the endowment, disruptive spending drop risk fell to 5%. The average worst spending drop decreased to 12%, and purchasing power impairment risk declined to 2%. Yale Investments. The recovery wasn't driven by a new asset class. It was driven by the gradual correction of spending rates back to the level the principal could actually support across a full cycle. Some endowments needed a decade to complete that correction. Those who hadn't been overextended completed it faster. Not all crises are equal. A few endowments that had stayed closer to liquid allocations and conservative spending targets barely registered 2008 as a crisis at all. For others, it reshaped how they operated for the following decade. And here is where the thread that has been running through this entire story from medieval Oxford forward becomes most visible. The mechanism was never the asset class. Land, in the 13th century, was the vehicle available. U.S. equities, in 1950, were the vehicle available. Private equity and timber, in 2005, were the vehicles available. The mechanism was always the ratio. What you spend relative to what the principal can sustainably produce. The institutions that survived 500 years of wars and reformations and currency changes and market collapses didn't do it by finding the perfect asset. They did it by protecting the gap, every single time. The modern equivalent of this is sitting in every savings account, every pension statement, every investment portfolio you carry. Most financial advice focuses on returns. How much did your portfolio earn this year? Most financial anxiety focuses on market volatility. Did the value go up or down? Neither of these is the primary variable. The primary variable, the one the oldest institutions in the world built their survival architecture around, is the withdrawal rate. Now, how much are you taking out? And does that amount allow the principal to grow in real terms over the long arc? If you're drawing down faster than your real return after inflation, you are moving in one direction. The gap is closing. And once it closes, no asset class saves you, because the principal that would have compounded is no longer there. The medieval bursar, crossing out tenant names in the Berkshire rent roll, understood this without ever having studied modern portfolio theory. He just kept the accounts going. He didn't sell the land. The question you can answer right now, with your own numbers in front of you, of everything you currently hold, savings, investments, property, pension, what is your effective annual withdrawal rate as a percentage of the total? And is that number honestly calculated, or lower than your realistic long-run real return? Not your best year, your long-run real return. If those two numbers are the right way around, the architecture is holding. If they're not, the gap is closing, 1 year at a time, without any visible alarm. Comment the number below, your honest estimate of your current withdrawal rate as a percentage of what you hold. Not because there's a right answer, because the people who have had to think about that number tend to make different decisions than the people who haven't.